Today we will have a look at Caterpillar stock and figure out if it's still a buy after soaring by 17% over the past 6 months. Now, to analyze Caterpillar, we will use the 9-pillar analysis and calculate the intrinsic value of the company using our 4 valuation models at the end of the video. Now, jumping back to the stock screen, we can see that Caterpillar has a dividend yield of 1.48% with a dividend payout of $5.64 and a decently low trailing free cash flow payout ratio of only 36.42%. And to me, a low trailing free cash flow payout ratio is very important as it tells me that the company generates enough free cash flow to support its dividend payouts as well as its growth, while still having leftover cash flow to raise their dividend or buy back shares or pay off debt. Now, jumping straight to the 9-pillar analysis, we can see that the company gets a top rating of 9 out of 9. And the first thing we want to have a look at is the 5-year PE ratio, which is currently sitting at about 20, which means that investors are paying $20 for $1 of Caterpillar's earnings. And if the P ratio is too high, so about 22.5, it means that investors are overpaying for the company's earnings, and so the company is trading expensive. Now, if we have a close look, we can see that Caterpillar has been declining their PE ratio over the past 5 years, and in 2023 it was sitting at 12.70, but currently it's sitting at 17.68, so a slight increase from 2023, but it is still lower than the 5-year average, so we can see an overall decrease in the PE ratio. So that's a tick for the PE ratio. Now, looking at the price to free cash flow, which is the same thing as the PE ratio, except we have a look at the free cash flow, the price to free cash flow. And this is sitting over the past 5 years at 17.79, again in the range we like to see. And if we have a closer look, we can see that that as well has been declining, although at a slightly lower rate, but currently is higher than the 5-year average. So we can see that investors are starting to overpay for Caterpillar's free cash flow, but it's sitting at about 20, which is still in the range we like to see, so that's a tick as well. Now let's have a look at the growth of the company. We can see that their revenue has been growing at a rate of 5.41% yearly over the past 5 years, free cash flow at a rate of 27.5%, and net income at a rate of almost 31%. Now, if we have a closer look at the revenue, we can see that that indeed has been increasing at a very decent steady rate. Regarding the net income, that as well has increased from about 6 billion in 2019 to 10.3 billion in 2023, and year over year it increased by another 3.31%, so great growth in the net income as well. And regarding the free cash flow, that increased from 4.2 billion in 2019 to 9.7 billion in 23, and this year it decreased slightly, but overall we can see that the company is steadily growing at very decent rates, so that is a tick for all 3 pillars. Now let's have a look at the company's decreasing shares outstanding. Caterpillar has been decreasing their shares outstanding at a rate of 2.67% yearly over the past 5 years, which firstly shows me that the company themselves believes that they are trading below or at their intrinsic value, and also by decreasing the shares outstanding they are growing their value as the market becomes less diluted, so a tick for this pillar as well. Now their 5-year profit margin is sitting at 26.99, and we want the profit margin to be as high as possible, because the higher the profit margin, the stronger the business's pricing power, and of course the more profitable a business is, the more net income and free cash flow, so a tick for this pillar as well. And finally, let's have a look at the long-term liabilities over the 5-year free cash flow negative dividends, which should be sitting below 1.5, and would tell us that on average over the past 5 years Caterpillar generated enough free cash flow to cover all their long-term liabilities, which they have, as their ratio is sitting at only 0.46, which means that they can pay off all their long-term liabilities in about 2.5 years, with the average free cash flow they generate yearly, so a tick for this pillar as well. And now let's also have a look at the consecutive dividend growth, which for Caterpillar is sitting at 6.54. Now let's actually have a closer look at the 8th pillar. We can see that Caterpillar has been increasing their dividends very steadily over the past 5 years, and their year-over-year growth is sitting higher than the year-over-year growth of an average company, though their dividend yield is slightly lacking behind the average stock dividend yield. But I don't really mind that, because with an above average dividend growth, we can really achieve a great yield on cost in the future. And as Caterpillar is a dividend aristocrat, they have been increasing their dividend payouts consecutively over the past 31 years. I do want to highlight their yield on cost. So if we go to the dividend yield tab and scroll down, we can see the year on cost over the past 5 years. So if you were to invest into the company 5 years ago, your yield on cost would be currently 3.88%, even though the company's current dividend yield is only 1.42%. So the money you have invested 5 years ago would yield you 3.88% instead of the current 1.42%. Now, if you find this video helpful, make sure to leave a like and subscribe as it really helps me out. Also, if you find these spreadsheets interesting, you can always download them at the link in the description. And now let's finally calculate Caterpillar's intrinsic value, first using the Grams formula revised. Now to carry out this evaluation, we have to plug in the 5-year earnings growth estimate, which I have plugged in at 8.39% year over year over the next 5 years. Then plugging this value into the Grams formula alongside with the other values, we get an intrinsic value of $266.61, which is 43% lower than the current trading price of the company. But let's jump to our second valuation model, the discounted cash flow model, where we have a look at the free cash flow of the company. Now, over the past 5 years, the average growth rate was sitting at 27.58%, but as we are predicting the free cash flow growth for the next 10 years plus, I calculate a growth rate of 5.7%. And using that, I calculate the future free cash flow over the next 10 years, including the terminal value. I then plug in a discount rate at 8%, which is the minimum rate of return I would like from an investment into Caterpillar, and calculate the present value of that future free cash flow. I then sum all of that up, add cash and cash equivalents, and subtract total debt to get an equity value, which I divide by the shares outstanding and get an intrinsic value of $442.53, which is actually higher than the current trading price. And now jumping to the third valuation model, the multiples valuation, where we compare Caterpillar to two of its competitors, so companies in the same sector. We take these companies' current stock prices and divide by their earnings per share to get their PE ratios. Then when we average out these PE ratios, we can see that the average PE is higher than the PE ratio of Caterpillar. So when we multiply this average PE ratio with the earnings per share of Caterpillar, we get an intrinsic value of $399.84, which again is slightly higher than the current trading price. And now for the final valuation model, the dividend discount model, we plug in the dividend raises over the past 5 years and calculate an average growth rate of 6.61%. Now I project a very similar growth rate into the future of 6.67%, and using that we predict the next year's dividend, and combined with the discount rate at 8%, we get an intrinsic value of $408.50. And now finally arriving to our ultimate intrinsic valuation, we average out the four models and get an intrinsic value of $379.37, which is basically spot on with the current trading price, showing us that Caterpillar is currently very fairly valued. But if you did want to buy the company with a margin of safety of 10%, you would have to wait for it to drop to $341.43. Now, Caterpillar is currently rated as a hold by Wall Street quant and seeking alpha analysts. And in this case, I do believe that they are right. I would myself give the company a hold, as based on our analysis and based on the intrinsic value of the company, I do believe that it will drop lower. And when it does, that will be the time to buy the company at a discounted price. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.